Yes, good afternoon, everyone. My name is Deji Babalola, part of the African Business Club. We have a financial literacy discussion series for today. We're excited about investing in the stock market. The purpose of African Business Club is to normalize financial literacy within our community. We know there's a lot of misconceptions, miseducation in our community. So that's the goal of that's the whole purpose. So I'm going to let Pam take over, break down just the logistics and how we usually go about with the phone conferences for this series.
All right. Good evening, everyone. My name is Pamela. So essentially, the way the series goes is we have the introduction, we introduce the guest speaker. He speaks for about 10 to 15 minutes, and then there's a question and answer section. Without further ado, we have our guest speaker, Dr. Haynes. I'm sorry, I don't want to butcher your name.
Yes, it's Dr. Hans Boateng. Yes, and I just wanted to confirm, what's the timeline for the entire presentation?
So the time,
including Q&A.
So I would say about 30 minutes.
Okay.
Well, including Q&A will be, the total is an hour.
Okay.
It's including Q&A. So
okay,
all the way to 6 p.m. Yes.
Oh, excellent. That's good to know. Excellent. So yeah, when you're ready to have me begin, just go ahead and mute everyone so that we don't have any background noise and I can jump right in.
All right, I'll go ahead and mute everyone now.
Excellent.
This is getting ridiculous because I just keep going and it just keeps raining.
It's a ball.
Perfect. Hey everyone, Dr. Hans here at the Investing. Okay, I don't think I hear any background noise now, so perfect. So everyone, Dr. Hans here, the Investing Tutor. And what I do is that I help professionals with careers build wealth by teaching them how to invest. You know, in listening to kind of the opening of our discussion today, you mentioned how there are a lot of misconceptions out there when it comes to the topic of money, investing, and building wealth. You know, as an immigrant myself, for the past 12 years, I've taken my time to really study the US financial system. And I'm going to be sharing with you a lot of the misconceptions that I've come to realize, as well as the strategies by which we can take full control of our financial future so that more of us, Africans, immigrants, or anyone with limited income, more of us can build wealth in this great country. So without further ado, let's go ahead and get started. So there I am. You know, I tell the story of how growing up, my parents used to tell me, Hans, if you want to be rich and successful, what you need to do is you want to become a doctor. So, you know, my mom consistently repeated this throughout my childhood. So when I got into college, I knew that to make my parents happy and also to become rich and successful, I had to become a doctor. So let me take a step back and kind of walk you through how I even got to the point in this picture to be receiving my white coat. It was a white coat ceremony for the Doctor of Pharmacy program. So when I came to the US, I'll say my life started out in Bronx, New York. I attended community college. And like most immigrants, it's a humble beginning. You know, back home in Ghana, we used to live the upper middle class lifestyle. But then when I was dropped off in Bronx, New York, things quickly changed. The movies that I had watched on TV of beaches and, college parties, that was not the reality in the Bronx. We lived in a 1-bedroom apartment, shared that with our family. I had a job where I was being paid $6 an hour at a children's clothing store. And that's what I did. I noticed that all of my colleagues around me, they were focused on only one thing. How can I quickly make a lot of money so that I'm not earning minimum wage? So instead of them going to school to, educate themselves or to acquire skills that will enable them to earn more money, they were instead looking for like jobs that would pay $15 an hour. Because back then, if you're earning $6 and someone else is earning $15 an hour, they're like, oh my gosh, I'm rich. So most of my colleagues followed that short-term mentality of, can I make money quick? What I did instead is I stayed focused on the goal that my parents had shared with me. Hey, Hans, if you want to be rich and successful, you want to become a doctor. So instead of going to medical school, I chose to go for a doctor of pharmacy program. One, because the MCAT, after I saw that physics was part of that exam, I was like, no way. and number two, I just don't like the whole concept of working with blood and anything of that nature. So pharmacy was a perfect fit. And for me, what I loved about pharmacy was the fact that as a pharmacist, you can interact with individuals in the community. They just come to you and then they can ask you questions. They can get to know you. You can get to know them. So that's what drew me to the profession. So I got into pharmacy school in 2010. That first year was when this picture was taken. As you can see by the smile on my face, I just had a sense of pride, right? I had accomplished the dream that my parents always said, hey, Hans, if you want to become rich and successful, become a doctor. So that smile on my face was me saying to myself or knowing deep down that, oh my gosh, I am going to be rich. But friends, I soon learned that the rich don't work for money. And that completely shifted my entire life. And you're probably wondering, where did you learn this? I met this gentleman, a millionaire, right before I got into pharmacy school. And the gentleman asked me to read a book. The title of the book is Rich Dad, Poor Dad. Robert Kiyosaki's book, Rich Dad, Poor Dad. It is the #1 best-selling personal finance book literally in the world. So I read the book, and the first chapter of the book said, the rich don't work for money. And I was so confused because as an immigrant, as a person who, if you grew up in a home where you didn't have a lot of money, you are told and you're taught and you know that you have to work to make money. And that's why my colleagues, when I started community college, many of them were looking for those high-paying $15 an hour jobs or $20 an hour jobs because we are conditioned to work for money. So now this book is saying the rich don't work for money. And I was confused. I was like, okay, if rich people don't work for money, then what do they do? So I continued to read and I discovered that there are 2 ways. Friends, pay very close attention to this. There are only 2 ways to build wealth in this world. Only 2 ways. The first way is to start and own a business. It's one way to build wealth. The second way to build wealth is by investing. That's it. Owning a business or investing. And when I found that out, I was like, wow, Why didn't anyone tell me this? So I immediately started this journey of acquiring as much knowledge that I can about starting businesses and investing. So I started to read every single book on investing, personal finance. How does a person build wealth? I just taking all of this information. So throughout my, time in pharmacy school and even beyond, for the past 10 years, I've read over 400 books on the topic of personal finance, investing, wealth building, and I've read over 40,000 articles, journals, financial reports. So what I'm going to be sharing with you in the next couple of minutes, it's not just my opinion. It's backed by decades and centuries worth of data. So let's go ahead. The average person doesn't realize that they have to pretty much anytime you focus on a salary or being paid for your time, you have to do this majestic walk. And every single individual who focuses on only trading time for money, especially at a job, this is the work that they have to do. If that individual doesn't learn about investing, if they don't learn how to take advantage of tax-deferred investment accounts or things of that nature, anytime they grab their salary, as you can see in this image, the first person that's going to get their cut is the tax man. That individual comes, takes their portion. Next, bills. If you've lived in the US, you know very well that there are a ton of bills that are due each month. After you're done taking care of bills, guess who's next? Loans. Oh, wow. And after you're done with loans, yep, the insurance lady in the last window. And there are other expenses as well. So as you can see, things are set up, or the US financial system is set up in such a way that if you do not prioritize investing, you will never get the opportunity to. This is why if you take a very close look at immigrants, minorities, or individuals with a limited income, many of them will work really hard their entire life. I watched it and saw it for myself. I have relatives, many of them, who worked really hard. They lived in really nice homes, big homes. Some homes were $500,000. Others are $250,000. They drove really nice cars. Their kids went to the best schools in the US. But right now at retirement, they have nothing to show for all of the decades of work. Why? Because they didn't realize that the US financial system is set up this way. You get your money, taxes comes out, bills comes out next, loans go out, you're paying insurance, and so many other expenses. So what are you supposed to do to make sure you don't fall into this trap? You have to sign up for a retirement account through your employer. It is the first thing that you have to do, okay? This is very important because the moment you sign up for that tax-deferred retirement account through your employer, the 401k or the 403b, or if you work for the military, your thrift savings plan, it means that once you get your salary, you get paid first because that money is taken off of the top, even before taxes. So friends, if you don't have, or if you're not taking advantage of your employer-sponsored retirement account, you are literally throwing money in the trash because most of them are giving what's called a matching contribution, meaning you put $3,000 in, you're getting $3,000 for your contribution, making it $6,000. Some of them, you put 2,500 in, you're getting an additional 2,500. There's a percentage calculation, but that is free money. So the number one rule for wealth building in the US, it is so simple. If I tell you this rule, you'll probably be like, wow, is that it? Yes, it's it. It's so simple, but let me share this with you. I heard this quote once by Jim Rohn, this gentleman. He said, what is easy to do is easy not to do. So what I'm about to share with you, it is the formula for wealth building, but it's so simple, you might overlook it. So if you're wondering, what is that secret? It is to pay yourself first. Whenever you get a paycheck, whenever you get money, you have to pay yourself first. The statement is that a portion of everything that you earn is yours to keep. That portion should be 10%. Okay, so if you earn $5,000 in a month, $500 out of that amount is yours to keep. It's not going to pay down debt. It is not going to pay off childcare or daycare. It is not going to relatives in Africa or Ghana or Nigeria. It is not going to do anything. That 10% is yours to keep. And that 10% is what is supposed to build you wealth over time. Okay? So the formula for wealth building is to pay yourself first. But what do everyone do? Most people just pay everyone else first, and they wonder why they are not able to build wealth. As you saw the majestic walk, right? The taxes, the bills, the loans, the insurance, the so many expenses. Yep. Everyone is just paying everyone else first. You make money and give it away, right? Until you learn this simple philosophy that I'm teaching you, you will never, ever be able to build wealth. Because if you come into money, or if you're given money, or if you receive money, if you don't keep a portion of it, how are you supposed to grow that wealth when you're just giving it away? So I hope that if you've always just been the person who gets money and by the end of the month or the end of the year, all of it is gone, you have to learn to keep a portion of that money for yourself. Now, I want to show you and I want to emphasize the importance of investing early. So if you look at the average family in the US, okay, so husband, wife, with a kid, let's say with 2 kids, or even if they don't have any kids, just a family unit, the average income in the US is $50,000. And I've told you that you should try and invest 10% of your income, okay? So let's look at an individual who starts out life. You're earning 50K, or as a family unit, you're earning 50K, and you decide to invest 10% of your income. So that's $5,000. Now, I'm not saying you have to wait and invest $5,000 a year. No, you can break this up into a monthly amount. So if each month that amount is $415, then you do that amount consistently, okay? Because it's going to add up to the $5,000 at the end of the year. Okay, so current principle is that first amount that you're investing, okay? Annual addition, okay, just means that you're going to consistently invest that amount over time. And years to grow is saying that you are investing this amount, whether it's $415 each month, or let's just say $5,000 each year, you are investing it over a 40-year period. So what I like to say with this example is, let's say a person is 25 years old, okay, because from 25, okay, to 65 is retirement age. So from 25 to 65 years is 40, it's a 40-year time frame for your investments to grow. Now, if you look at the interest rate, I've written 10%. Many of you listening, you probably don't know this. The US stock market, okay, I'm not even talking about picking individual stocks. I'm talking about the entire US stock market as a whole. It has been returning 10% on average for the past 100 years. So if a person didn't know how to invest and all they did was to just put their money in the entire US stock market, it's called an index fund. So the S&P 500 index fund, it's been returning 10% on average for the past 100 years. So investing $5,000 a year, or let's say $415 a month, over a 40-year time frame, gives you $2.6 million. Friends, just look at that. $2.6 million by just doing this consistently over time. Now, let's look at the opposite. The people who decide to wait because they are waiting because they want to save for a house, right? The people who don't start investing early, they are waiting because they want to pay off all their debt. They are waiting because they want to get married. So they are not going to invest the 10%, even though they can still use the 90% of their money that they are not investing to put towards all of these other things. They just ignore the 10% that they can pay themselves first with. So look at this. If you decide to wait just 5 years, look at what happens. If you notice the years to grow, I've placed a red arrow next to it. I've reduced the years to grow from 40 years down to 35 years. So I've just reduced it by 5 years. So meaning this person, instead of starting to invest from age 25, you just waited 5 years. So you're starting to invest at age 30. Most people say, oh, 5 years is not that big of a deal. Look at the amount at the bottom. 5 years wait. How much did it reduce the investment by? $1 million lost. And this $1 million, you will never recover it again because lost time is gone. You can't create more time for your investments to grow. Many people don't realize that time is a finite resource. Once it's spent, it's gone. So by waiting 5 years, a person was losing $200,000 every single year they were waiting. You know, I talk to the average person. They tell me, oh, Hans, you know, I don't want to start investing because I have some debt that I need to pay off. Okay, I hope your debt is over $200,000 for 1 year, because if it's not, then you're losing a ton of money to be focusing only on debt. Or some individuals who say, oh, you know, we just want to save for a house, or I just want to save and have money in my emergency fund. Okay, I hope you are comfortable losing $200,000 every single year you wait to invest. It's very expensive. 5 years doesn't seem like it doesn't seem that long, and the cost isn't apparent until you look at a compound interest calculator, and all of a sudden you realize that, oh my God, why didn't they tell us this? Why don't they show this to us? And friends, this knowledge, this information has drastically changed my life. So what are some of the old school beliefs about money that doesn't necessarily help our generation? Because you have to understand that the economic system that we're living through is vastly different from what many of the old school experts in the financial realm, those who don't adapt to changing circumstances, right? Many of those old school experts realize that things have shifted. They are sticking with their old central beliefs. What are some of these beliefs? Save as much as you can. And the question is, how much are you getting on a savings account, right? Because that old school expert back then, when they were starting their financial journey, interest rates on savings accounts were about 10% or 12%. So it makes sense to save as much as you can because you get that 10% or 12% on your savings account. But right now, how much do you get on a savings account? 0.01%. Friends, saving at a 0.01% rate of return, all right? 0.01. Let me go ahead and actually just do the math here real quick. Rule of 72. Let me see. Saving at a 0.01% rate of return will take you 720 years for your money to double. Many people don't realize the cost, once again, of just hoarding money in a savings account. Now, don't get me wrong. There's a purpose for a savings account, and we'll talk about it soon. But the concept of save as much as you can is false. The next one, investing is very risky. You know, often when an individual or when people don't understand something, they just say that thing is risky, right? We can also say driving a car is risky or swimming is risky. Why? Because imagine you've never gone to driving school. You've never been taught how to drive. And one day you're in a car with your parents, okay? They are driving on the highway, then they pull over and then they tell you, hey, little man or young girl, come and take over the car and drive us home. Would you say that's risky if you don't know how to drive? Yes, of course it's risky. It's a highway, you don't know how to drive, it's very risky. But if you go to driving school, if you have someone sit next to you and teach you how to drive, all of a sudden, if you're with your parents and they tell you to come and take over and drive, it is no longer risky, right? So knowledge reduces risk. So investing by itself is not very risky. Many people that's even listening, you all listening to this presentation right now, many of you probably did not know the stock market for the past 100 years, the market has never lost any money on average. It's been returning 10%. So just saying investing is very risky is an excuse. What you want to do is you want to educate yourself. Another old school belief, debt is bad. It's just a blanket statement. Debt is bad. To me, when I hear that, I'm reminded of electricity, right? If someone goes to play around with electricity and they get shocked, and all of a sudden they just say the blanket statement is electricity is bad. Is that true? No, it's not true. Electricity can power a house, and sure, it can shock a person to death. It doesn't mean that electricity by itself is bad. It depends on how it is used. You notice that? So pay attention. Don't just make blanket statements about things. You have to understand the use of that thing. If debt is used to acquire a degree, that then pays you back money, and that money pays off the debt and you are earning money for the rest of your life, that debt isn't bad. If you use debt or credit to acquire a rental property and individuals are living in that property and paying down the mortgage, and after the mortgage is paid off, that property is still making you money, that debt isn't bad. If you go use a credit card to go buy expensive clothes so that you can show off and let people feel like you are rich and wealthy, while the clothes that you're wearing depreciates in value and becomes worthless several years from now, that debt is bad. So you notice you have to understand the use of the debt. Don't just have a blanket statement that debt is bad. So what's the better strategy? Or what's a new strategy that fits and supports our generation when it comes to the topic of money and investing? The first is you have to save for an emergency. Okay, you have to save for an emergency. It's the first thing that you have to do. And just so you know, these strategies have to be done together. So save for an emergency, meaning that when you get your income, you're saving a portion of it in a savings account, or what I like to say, an emergency fund. And that account can hold 6 months worth of expenses. The next thing that you want to be doing is you want to be paying down debt. So notice this new strategy requires you to do them simultaneously. So save for an emergency, pay down debt. So you'll be putting money towards paying down debt. And the third thing that you want to also be doing from the get-go is investing for the future. So friends, save, pay down debt, invest for the future. So I'm going to be wrapping up so that I can take Q&As. But maybe I can answer these questions in the Q&A session. Individuals might wonder, what is the stock market? The stock market simply values or measures the value of companies. That's all that the stock market is doing. So many people don't even know this. It is where people go to buy and sell, let's say, stocks or securities. But what the stock market is doing is measuring the value of companies. So what is a stock? A stock is just an ownership stake in a company. So if you buy a stock, you own a piece of a company. How do I buy a stock? I'm going to show you how in the next slide. The next question is, should I invest or should I pay down debt? The simple answer I have for this is do both. Remember the last slide, the new strategy. You want to be saving for an emergency, you want to be paying down debt, and you want to be investing for the future. And if you're wondering, where can I go to begin investing? Cash App. Often when I say Cash App, many people are like, wait, what? Cash App? You can invest with Cash App? Yes, you can. So I like to say that individuals have gold right around them and they don't even know that it exists. If you open Cash App after our presentation and you look right next to the money sign, you see that line, which I've kind of highlighted there. If you click that, that is the investment portion of the app. Okay. Now I know, some other questions that I'll get soon, and I'm about to go into Q&A in the next minute or so. I know many of you are going to ask me, how do I begin investing? Or if I want to start investing, how do I start? So just go ahead and write down this website. I'm going to just give you 10 to 20 seconds to write this down. Okay. So it is stockmarketcrashworkshop.com. The website again is stockmarketcrashworkshop.com. I've put together a 45-minute to 1 hour presentation on how to begin investing in stocks. And I know that it's going to benefit many of you. And I've gone ahead and I've put a coupon code on the website so that if you all visit it, you'd be able to take advantage of that coupon code. So I'm going to go ahead and open it up for questions. And if you want to connect with me on LinkedIn, just search for me, Hans Boateng, on LinkedIn, and you'd be able to find me. So yeah, if you have any questions, I don't know, are we taking the questions like audio or are people typing it in? Either or, I'm fine with that.
Hi, I have a.
Oh, go ahead. I think so. Actually, before that, I was just gonna say, yeah, we'll do audio, and whoever's asking question, just unmute yourself, and obviously announce your name. We'd like to know who's participating. Thank you.
Thank you so much for that clarity. My question was, would this be recorded in the future just in case? Because sometimes I have like internet disconnection. So if you guys can record it as a practice, so that way I can go over some of the videos and some of the tips. But I really appreciate the knowledge.
I'm guessing this is being recorded because I see the record sign.
Yes, we are recording this, and also we are actually collecting email addresses. We send that through the chat, so if everybody can send their email. So the plan is to send this to everybody also for the recording. So yeah, we actually do recording.
Thank you so much.
Dr. Ans, I have a question.
Yes, go ahead.
I think someone else has a question that could wait.
Yes, my name is Grace. Thank you for this information session. My question is, considering what's going on now in the economy of the world, do you recommend that people invest? Is this a good time to invest in stocks? And also considering the fact that all of our retirement savings are pretty much crashing, what is your advice? Do you just kind of leave things alone? Is the money gonna go back up, or what's gonna happen?
Absolutely. And Grace, how old are you?
I'm 28.
Oh, 28, and you're worried about your retirement accounts because it's just a little bit? Come on. What about individuals who are close to retirement right now who are seeing millions of dollars reduced by 40%?
I feel for them. I feel for them, but
Yeah,
hey,
Grace, you have nothing to worry about. Like you learned in this presentation, the stock market averages about 10% year over year. Does that mean that the market doesn't correct? The market can correct. On average, we have stock market corrections every 10 years. It doesn't mean it happens every 10, but it just seems like it's happened that way. In 2000, there was the dot-com crash, right? We had a strong pull. In 2007, 2008, we had the recession, and now we have the coronavirus. They're like 10 years apart, step by step. After every downturn, there's a significant upward trend. From 2007 to 2009, the stock market lost 55%. If you were on a recording or a presentation like this, I would have told people back then, leave the money alone and actually invest more. Many people would have said, what are you talking about? My investments are going down. Guess what happened? From 2009 to 2020, the stock market is up over 400%. I'm going to repeat that again. Stock market is up over 400% for people who left their money. You have to understand how the stock market works. You don't get it. The market is just measuring the value of pennies in the economy. Stock market to crash and go to zero, which some people think the stock market can do that, it means that every company in the US will become worthless. Okay, think about that for a second. Disney, Apple, Microsoft, Amazon, Lowe's, Home Depot. I can go on like and mention all the companies that you all know, and even some of the companies you even work for. Can you imagine all of those companies going to zero? Is that possible, Grace? I think she's on mute.
I have a question.
Yes, go ahead.
All right. My question is that, okay, I actually invested in through Cash App, right?
Excellent.
But it's like I don't know where, I don't know which one. It's a lot of they have a lot of companies there.
Absolutely.
And they have a lot of like you see how it's going down, and that scared me. So how do you know which one, which one to where to go?
Absolutely. And who am I speaking with?
Oh, my name is Nike.
Nike, it's so nice to speak with you. Yeah, Nike, the simple answer to your question is, and this is a statement that I share with anyone that I get the opportunity to work with or anyone who takes any of my programs, only invest in companies love and understand. That's it. And when you invest, forget about looking at it with it go up and down. The up and down doesn't matter. People buy homes. Listen to this carefully. You buy homes, okay? When you are living in the house, you don't go check the property value every single day to see whether the property value is up or down. Don't do that. The only time you check property value is if you're ready to sell the house. So people have to start looking at the house that same way, right? You don't look at it on a day-to-day basis. You are investing money in a company that you believe is going to grow, right? And over time, if you are selecting the right company, it is going to grow. So the other part of your question is, how do I know if a company is a good investment or not? The first thing that I said, make sure it's a company you love. Okay, so is it a company that you use? Do you use their products? Do you use services? Because if you do, then you're going to love the company. The other part is you need to understand the company from a financial perspective. That I cannot teach you verbally how to do that, right? That's why I have the stock market crash workshop. You're going to be able to learn it that way, how to look at a few things. It's very simple, actually, to look at the financial side of a company to understand it. It's very simple. It'll take you less than a minute to be able to know if a company has good financial, like a good financial status or not, right? So invest in companies that you love and just make sure you're able to understand them from more of a financial standpoint.
Hey, Dr. Hans, thank you for
Yes.
that question. This is Wale. I have a quick question for you.
Sure.
This question is around the preference from investing in an S&P fund versus investing in maybe single stock for different companies. Which one do you advise, or is it based on the person's risk appetite?
No, well, your last statement is a very, very, very good point. So ideally, I would say it depends on okay, let me just take a step. The simple answer to that is you should be invested in 3 core investments. And I'm not talking specifically you. This is a general statement. Every individual should be invested in 3 different investment vehicles. The first is a retirement account through the employer. The second is an investment fund. So that constitutes the S&P 500s, the index funds, all of that. And the third is a stock. And the reason why these 3 are very important is because the retirement account is just free money. You need to get it. The second is more of a low risk way to invest. But then the stocks allows you, if you know what you're doing, to be able to build exponential wealth. Because, for example, a person who invested $1,000 in Amazon, just $1,000 in 1987, that money is worth $1.2 million today. You cannot get that kind of a return from index fund. That's why you want to give yourself exposure to these 3 investment vehicles. Now, right now, with the stock market having pulled back about 20-25%, it makes more sense to buy stocks now. When the market recovers to where it was before this downturn, which it will, so that also answers, I believe, Grace's question. At that point, then we can go back to focusing on, the index funds and this. But if an individual is looking for an opportunity to leapfrog or take advantage of the current times, stocks is definitely what you need to focus on within this small window of opportunity that we have.
Thank you so much. That was a very good explanation. I appreciate it.
Dr. Hans, hi. Dr. Hans, can you, so from your stuff, you've read a bunch of books, right?
Yep.
Can you just speak to everyone knows the importance of budgeting their money so they can have that extra room to invest 10%? Because I think those are the underlying principles people need to know. Can you dig more into that?
Yes, so I want to make sure that I understand the question. Can you repeat it, please?
Can you you read a bunch of books, and I'm sure they all pretty much say about the same thing after you read a bunch of books, right?
Yes.
Can you just say to the importance of budgeting money so people can have room to save that 10%? If not, they'll be running, the rat race every single time.
Absolutely, and I understand.
Just a little bit.
I understand, and that's a very, very good question. For me, the way that I like to look at my finances is very simple. And, some individuals are very strict. They itemize every single dollar that they spend. God bless them. For me, I just make it very simple. Simplicity to me is key. I look at my income and I look at my expenses. That's it. Your income is telling you the amount of money that you're earning, okay? And let me share with you another formula for financial success. It is spend less than you make and invest the difference, okay? So you look at your income and then you look at your expenses. If you subtract the income you have from how much you're spending and you see that you're in the negative, then it means that you are spending more than you make. You need to reduce your spending or you need to increase your income. It's up to you. For me, I love flexibility. If you see yourself, hey, maybe I'm spending a lot, but you know what? Maybe I can start a business, or I can start a side hustle, I can take on another job. Then God bless you. You do that, because once again, finance will tell you that the only way that you can free up money is to cut back your costs, which is that's the easiest you can do, and you should definitely of it if you are overspending on things that are not beneficial, right? Another aspect that is often ignored is you can also increase your income. But the best thing that you can do is actually to do both, to increase your income while you reduce your expenses. Because when you're doing both, you are allowing a greater gap of money that can then go to build you a significant amount of wealth. A portion of that money that's in the gap can also go to pay down debt, more, right? The gap can also allow you to be able to experience life. Like, for example, if you want to travel, or you want to, buy a gift for a loved one, or you want to send money back to parents or relatives, you can do that if you have more. Does that make sense?
Yes.
Excellent.
Dr. Han, sorry, this is Wale. We have a question. Somebody typed a question.
Okay.
This is from Mohammed. He said, this might be a silly question. What's the minimum amount you should invest as a starter?
So there isn't really a minimum amount. In the past, they used to say you need thousands of dollars to begin investing. That's not true. You don't need $1,000 to begin investing. With cash, you only need $1 to start, right? With other fractional share investing apps, you need $5 to start. So there isn't really a minimum amount. Remember the rule, pay yourself first. What's the percentage that I shared with you? I said to do 10% of your income. So if you're earning $2,000 a month, 10% of that is $200. Does that make sense? And like the previous question, most people are spending way more than they earn. And as a result, you don't have any money left to be able to invest. So please pay attention to your expenses. And also, if you have the opportunity, take a look at how you can earn more money as well.
So, hi, can you guys hear me? Hello?
Yes, we can.
Oh, all right, cool. This is Ayo. I have a question.
Go ahead.
So I've invested over the past 2 years or so on betterment.com.
Betterment. Yep.
Right. What are your thoughts on Betterment's wealth funds, or this kinds of index-based funds as compared to your more standard Vanguard or Morningstar investment company?
Absolutely. So Betterment, what they are doing is essentially acting as a financial advisor. And instead of taking like a 1% or a 2% fee, what they are doing is they are taking about 0.25%, right? And they are putting you into a mix of different investments, from S&P 500 to international exposure to index funds to, even some bonds as well. And you don't have to do anything. So that type of approach, which is called robo investing, is essentially doing what a financial advisor would do, but at a lower cost. If you're going with like a Vanguard and you know how to invest. So for example, the clients that work with me, they are learning how to invest so that they can buy that index fund directly. They don't have to pay the 0.25%, through Betterment. But if a person does not want to take, let's say, an hour to learn how to buy an index fund, then Betterment is the best alternative for them. And just know that it fulfills the second investment vehicle that I talked about. Remember, I said retirement account, investment funds, and stocks. So Betterment literally fulfills that middle portion. It's just that they are charging 0.25% to be able to do that, which is cheaper than a financial advisor, but it could be much less if you knew how to invest directly in index funds.
Yeah, but if you were to go through, like, for example, Vanguard, don't they charge you for each trade that you?
No, they don't.
Thank you.
Yeah, my
Okay.
pleasure.
I have a question. My name is Kehinde Ojutala. I'm a short-term trader. I wanted to ask you about the Cash App. Does the Cash App, does it allow you to hedge against your position?
No, it doesn't. Cash App is for beginning investors. No. Yeah,
Okay.
no.
Okay. I just wanted to know, just because of the COVID-19 and stuff like that, because the risk was just too high and the market went by about 30%.
Well,
a lot of people are losing their 401k.
No, people are not losing their 401k.
They're losing a lot of money.
No, they are not. I gave the example with the 2007, 08, and 09 downturn. The only time a person really loses is if they sell their investment after it's down 40%. That means you've realized that loss. If a person doesn't touch their investment, that loss is not realized. Does that make sense?
Yeah, it makes sense. It makes sense.
Yeah.
But the thing about it, it takes time for it to go up too at the same time, correct?
Yes, but if a person is 28 years and they are retiring at 65, I mean, they have 40 years. So.
Okay.
I have a question. This is Grace again.
Yes, hi, Grace.
Yes, do you have any advice for those of us with mountain student loans? I think for me personally, that's probably my biggest worry. Considering the interest rate on it and how much it's literally increasing every day. Even after retirement and someone becomes a millionaire, when you look at the net worth of yourself after deducting the amount of loans you have, you basically still have nothing.
Well, that's false.
Okay, good. I'm glad to hear that.
Yeah, and Grace, I completely understand. And this is one of the core things that I wish and hope and pray that more people in our communities will understand. Now, don't get me wrong, paying down debt over time is important, but so is investing for your future. Because like I like to say, if a person has zero debt, okay, because sometimes debt is the only goal. Like, let me pay off all my debt. Having zero debt does not generate an income when you retire. Many people don't realize that. The thing that generates an income is investments. This is why it's important to have both going on simultaneously. So essentially what you're doing is you're reducing your debt to eventually get to zero while increasing your investments to build wealth. Does that make sense? So now to your question, you remember you saw the interest calculator that I showed you. How much is a person losing every year that they don't invest?
200,000.
200,000, but that's for someone who earns 50,000 a year. So let's say someone is earning 100,000 a year. How much are they losing every year that they don't invest?
I don't know.
It's just double. It's 400,000. So let's just do simple math here. Let's say a person owes $100,000 in student loans. This is simple math, okay? And the interest on that debt is 7%, okay? 7% of 100,000 is $7,000. That means that that loan is costing you $7,000 per year. Compare that to 200K or compare that to 400K. Which one seems like a scarier thing to ignore?
Yeah.
Dr. Hans, sorry, this is Wale. I know we are at 6 p.m. Eastern time.
Yep.
So if any of the participants or any of the callers that wants to drop off, they can, but if anybody wants to stay, they're more than welcome to stay for another maybe 10, 15 minutes. And Dr. Hans, do you have time?
Yeah, I do. Mm-hmm.
All right, so if anybody wants to drop, they're more than welcome to, but anybody that wants to stay, they can stay and continue to ask questions. Thank you so much, everybody.
My pleasure.
Right.
Yeah, go ahead.
I have a question.
There is a question that was posed online, so I'm going to read it out, okay? This is from Aya from Cincinnati.
Sure.
How do we balance paying yourself first when the obligations you mentioned, loans, bills, insurance, are not optional?
Yep.
But debts that can't be wished away.
Yep.
You would have to decide what your ROI is on your savings versus interest on debt. Is there a way to navigate this challenge?
Very, very, very good. Many people think that debt cannot be wished away, but they think that their ability to retire can be wished away, right? it is a mental shift that you have to realize. So first and foremost, do not feel that debt is a required payment, but your investment in yourself to be able to stop working at a certain point in the future is not required. That is not true, right? So, well, the question then is, how do I navigate this? And I think it's just what I shared. You have to look at your income and look at your expenses and figure out what you have to do there. Are you reducing your expenses, or are you increasing your income, or are you doing both? If you do that, you're going to free up more capital. But the number one thing that you have to do is to pay yourself first. Now, if you cannot do 10%, start with 1%, but at least start somewhere and slowly increase it over time. But in my opinion, the thing that you do not want to do is to ignore your, like, investing in yourself to be able to retire someday. Right? It's just so important. So I just hope that looking at your income, looking at your expenses is just a good starting point for you.
Okay, I have a question.
Sure.
Hi, my name is Gisma Ali. I wanted to know about the workshop. What all does it entail?
Sure. So the workshop is, in my opinion, one of the best things that anyone can take or listen to. So the first 40 minutes of that workshop is teaching you about a stock market crash. It's also teaching you about the stock market. It's teaching you about things like the Federal Reserve that you hear on the news. People don't understand anything that's going on. And because of that, they miss opportunities. Many of you listening or seeing all of the news on the TV, you probably don't realize this is the best opportunity of a lifetime to be investing. Why? Because you have a temporary virus that has disrupted the economy. Keep in mind, it's temporary. It has reduced the value of companies temporarily. But after that virus is, brought under control, or after it peaks, you have to realize that the companies will go back to its existing value and continue to grow from onwards. So then that gives you a short window of opportunity to be able to understand what's going on, understand how the stock market works, which is all covered this in the stock market crash workshop. And after that, depending on the option you select, if you select the beginner stock class, I have a 15-minute class which will show you how to be able to analyze any company's stock in 60 seconds. So it can be any company. It can be Disney, it can be Apple, it can be Amazon, it can be Netflix. You'll be able to look at that company, and in 60 seconds, you'll be able to know if it's a good investment or not. Because remember, I say only invest in companies that you love, understand. So you are going to know if you love the company, but to be able to understand it, you have to be able to analyze it.
So, Dr. Han, this is Busala.
Okay, thank you.
My pleasure.
Hello, hi, can you hear me?
I can hear you. Please, you can go ahead and ask.
So I was going to ask this workshop, is this going to be on this platform, or is there something that we have to join on differently?
Yes, it's not on this platform, like it's not via Zoom. The workshop is something that I've created within my business. So you'd be able to go to that website, read through it. And if you feel like you want to learn how to analyze a stock so that you can begin investing and taking advantage of this opportunity, which we have right now, then you'd be able to sign up through the website. Like I said, there's a temporary discount code that I have on the website. Another thing that I forgot to mention is, as part of signing up, what I've done is I've looked at all the stocks that are trading, and I've identified 5 stocks that I feel and know have the greatest opportunity. So those 5 stocks, I'm investing in some of those companies as well. And if you see that investment report with the top 5 stocks, on the last page of the report, if you look at the bottom, right beneath the disclaimer, you will see the stocks that I'm personally buying. But yes, I mean, I wrote that report about a week and a half ago, and already many of them are up about 10% or so just in about a week and a half. And it's just the beginning.
Thank you.
My pleasure. So I had received some questions via text, so I'm going to answer some of them. And if you all have questions, you can interrupt. So the second one, the first one that I got, how does money actually grow in the stock market? So when you're investing in the stock market, what you're doing is that you're buying, like, you know, a piece of a company. Okay, so let's say you're buying Disney, and Disney is worth 100 billion right now. Okay, and you've put in, let's say, $1,000. If Disney grows and becomes a $200 billion company in, let's say, 5 years, then it means that Disney has doubled in value. So the $1,000 that you invested in Disney has also doubled in value. So the $1,000 will become 2,000, right? That is how money grows in the stock market. That is why you want to identify companies that you love and understand and invest in them for the long term, because companies don't just grow and stop. They continue to grow, especially if they're a good company. So the next question I have here, and you all, like I said, you can, you know, in between the questions, you can let me know if you have any other question. Is it better to use a $0 trading platform with a broker, or is it better to go with one that charges a fee? 100% go with the $0 trading platform. What industry do you see making the biggest comeback? For example, are you thinking oil, gas, airline, or cruises? Honestly, the answer to that question is I don't pay attention to the industries that are going to make a big comeback, because you shouldn't be investing based on industries, or you shouldn't be investing based on what is going to, you know, give you the quickest return. Short-term thinking is actually not the way that you want to invest. Remember, the rule is to only invest in companies that you love and understand, not necessarily investing by industry. Are there any other questions? Another question here is, we always hear having a diversified portfolio is a good thing to do. What does this mean, and what is the best way to diversify one's portfolio? So having a diversified portfolio just means that you are investing in different asset classes. So for example, maybe you have some money in stocks, and you have some money in bonds, or maybe you have some money in real estate, or you have some money in commodities. Commodities can be like gold, silver, things of that nature. Right? So having kind of like a mix of different types of asset classes, or even if you have stocks and bonds, that can be considered a diversified portfolio, right? So then not necessarily restricting yourself to just one thing, but then having a mix of them. So I hope that kind of explains, or it's helpful for the individual that asked that question. So if you want to know how do you diversify your portfolio, it could be as simple as having different types of investments. So let's say you have index funds. Maybe you have the S&P 500, but perhaps you can add on a medical investment fund, or you can add on finance investment fund, or you can add on, let's say, technology investment fund. All of these different funds add diversity or diversify your portfolio.
Okay, thank you so much, Dr. An. This is Dami.
Mm-hmm.
Okay, so we're just going to a close for the conference call. And we want to thank you so much for joining us today and providing us so much information.
My absolute pleasure.
Yeah, for anyone who still has questions or discussions, the conversation does not have to end here. You can always, if you are part of the WhatsApp chat, you can send in your questions there. We can keep the conversation going. And if you are not a part of that chat, you can DM us your phone number and we can add you to the chat. Okay, and also every week we do have a hashtag. And since our discussion is based on stocks and investing, so our hashtag for Instagram for this week will be Stocks 101. So if you see any information in regards to that, to stocks, you can tag us in the information, post it, or, you know, just any information that you don't want to post, you can send it to us and we can post it. Also, for anyone who has not sent in their email addresses, please do so in the Zoom chat. If you are joining through the dial tone, you can DM us your email address. And if you're on a WhatsApp group, you can also send us your email address through there. We'll send you a recording of this chat, with including Dr. Han's presentation. So if you want to, you know, go back to it, take more notes and ask questions, you are welcome to do that. Okay, Dee, I don't know if you have anything else to add.
Thanks, Dami. Dr. Hans, this is Dorian. I just want to say thank you so much. As you can see, people have so many questions, but we don't want to take many more of your time. And I'm sure people, you know, I already know people that text me saying they would like to talk to you after. So I will continue to share your information with everyone. And also, thank you everybody for joining us today. We really appreciate the time you guys have dedicated to this. Once again, this is African Business Club. Our goal is to normalize financial literacy, sharing of ideas, and collaboration between the African community. So we are open to keep doing that. And also remember, guys, we are all kings and queens, and we all need to treat each other as such. Part of that is also elevating each other and sharing ideas and information with each other. And that's what we're doing here at African Business Club. Like Dami have said, this conversation doesn't have to end. So please join us on Instagram, African Business Club 2020. And also we have a WhatsApp group where we share information every day, a lot of great information. So if you'd like to join, just let us know. With that said, I'll just say thanks, everyone. Peace and love, and we'll talk to you guys in 2 weeks. Thank you.
Thank you. Bye.
Bye, guys.